Hello, welcome to Intro to Investments. My name is Corey Lang. I'm a chartered accountant as well as a chartered financial analyst. I've got about 20 years experience both in the accounting world, mainly with First Nations, everything from bookkeeping all the way up to CFO. And on the investment side of things, another about 10 years experience there in various roles, including trading, broker, and portfolio manager. So I've got some experience in the field of investments, and that's what we're going to talk about today. So when we talk about investments in everyday, common language, we tend to think of things like we're making an investment in our house, for example, right? You renovate your kitchen, put some money into your home, and you want that to increase in value. So we say we're investing in our house. Alternatively, you might invest in yourself through your education, right? Watching a webinar, for example. You're investing in your own personal development. We're talking about something very specific today, and that's investments in financial assets, okay? So we're going to be talking about things like stocks and bonds, a few other types, but mainly just to set a base level of knowledge about investments. We're going to talk about stocks and bonds specifically. And so what do we mean by an investment when we're talking about financial assets? Well, we want the investment to do two things. One, we want that investment to increase in value, right? So if you put $1,000 into an investment, we want that to go up to whatever, 1,200, 1,500, really as high as possible. But we also want a second thing from that, and that's income or cash flow, okay? Some investments will provide a separate stream of income to you in addition to the investment increasing in value. Sometimes it's an optional thing, sometimes it's mandatory, and we'll see how that works with these different types of investments. But those are the two keys to what we're talking about in terms of investments. So what are some characteristics of investments? In the financial world, there's basically two ways we look at an investment, okay? One is risk. And I'm sure if you've heard people talk about the stock market, immediately some people think of, oh, that's very risky, or you can lose money in the stock market. Those are true to a certain degree, okay? We can lose money, yes, that's true, but we can also make money. And the risk of an investment is really the probability that you might lose on that investment, right? Not grow it, but actually the investment declines in value. So that's kind of the riskiness. And we also talk about something related to risk called volatility. Okay, you might hear people talk about volatility in the stock market or a particular stock like Tesla or something. What we mean by volatility is the value of that investment changes a lot, okay, over time. So yesterday, if your investment was 1,000, today it might be 2,000. If it's really volatile, it could be 10,000. So the more an investment moves up and down in price, we say that's more volatile. And volatile is basically volatility, I should say, is a measure of risk. Okay, so that's what we're talking about when we hear the term that stock is volatile, or the stock market's been very volatile lately. A couple of just examples here. A lottery ticket, for example, it's very risky. There's a high percentage chance you're going to lose your money, right? There's a very tiny chance that we'll make a lot of money. But for the most part, we know when we buy a lottery ticket, we're probably not going to get our money back. So we would consider that a high risk investment. Canada Savings Bond on the opposite end of the spectrum would be considered very safe. Okay, that's the type of security where we can invest in a Canada Savings Bond, and basically the government of Canada is guaranteeing that they're going to give us our investment back. Okay, so we're not going to lose any money. We would say that's basically risk-free. The only chance that we wouldn't get paid back is if something disastrous happened with the government of Canada. Okay, so that's really a risk-free investment. And there's a whole spectrum going from low risk to high risk. And different stocks fall along different parts of that spectrum, right? There could be a safer stock versus a more risky stock, as well as bonds, right? We have a varying range of riskiness of those types of investments. The other characteristic would be the return. Okay, what are we getting back from our investment? Going back to that definition, we want that investment to grow, and we might want to provide an income stream to us, right, in the form of cash flow. And if we look at different types of investments, we can see that not all of them provide a lot of cash flow, but they may provide more growth in the actual investment. Again, some examples: art or collectibles. These are types of investments where you're not going to actually get any stream of cash flow. You just want that object or art piece to increase in value. Okay. With stock investments, we have more options there. Okay. So some stocks will only be focused on growth, right? The company just wants to put all their money back into the company and to grow the value of your stock. Alternatively, some companies are more mature, right? They've been around for a long time, like Walmart, for example. They might want to be willing to return some of their profits back to shareholders. So they're going to give you something called a dividend, right? And every quarter, they'll give you a check for some money. That's your share of profits that they're willing to give you back. Your stock price might also increase in value, but in the meantime, they're giving you a regular, steady income stream. Okay. Bonds work a similar way. Bonds, you invest a certain amount of money, and you're essentially lending some company that money. They're going to pay you an interest payment, right? And when you invest in that bond, when that bond matures, they give you some money back, and you get your investment back. It doesn't grow a lot, but you've earned that income through the interest payments. Okay. And then cash. Of course, cash is obviously not going to grow in value, but we're going to get an income stream through interest payments. Obviously, when interest rates are quite low, that's going to be a very nominal amount. But don't forget, cash is risk-free. Okay. So when we invest in cash, we're just saying we don't want to invest in anything risky. We want to keep our cash here. We don't want to lose this. So we need it in something safe. But we still might get a return through interest income. Okay, so two concepts there, risk and return. And we can look at those two things for any investment. Decide how risky is this and how much return are we going to get. And we'll see that these are actually related, right? Higher risk, generally speaking, means higher return. Okay, you're going to earn more money because the risk is higher, right? And we go back to the concept of volatility, we can see that if something moves up and down in price quite a bit, there's a better chance that we might make a lot of money. But on the downside, we might lose a lot of money. Okay, so those are very related concepts when we talk about investments. So let's dig into common stock investment, get a little bit more detailed here. So when you buy shares, they're also known as shares, you're basically investing in a business, okay? These are businesses that are publicly traded. So it means that you can go and access their shares on the stock market, right? Like the NYSE, TSX, things like that. You're basically, when you buy, say, 50 shares of a stock, that represents ownership in a company. And if you think of a pie, how you slice up a pie, each one of those would be one share, okay? And if your share is 50, say there's 500 shares, the whole pie is 500, your 50 represents 10% of that company, okay? So you own a piece of a business. We'll talk about what that gives you the right to do. Basically, there's a couple of things, but the main thing is you have the right to elect the board of directors. Okay, so when you own a portion of a company, you're allowed to vote at the annual meeting, and there's a board of directors that basically is in charge with looking after the company for you on your behalf. And you're going to elect those board of directors to basically watch management to make sure that they're doing what's in your best interest as a business owner. Okay. And you also get the right to any dividends that the company has declared. So remember, the portion of the profits that the company wants to share with their investors, those are called dividends. And it's going to be in the form of a check or cash will come into your account, and that's your share of the profits. So that's basically common stock investment or common shares. A couple of things that why you would invest in common stock instead of, say, a private business. Okay, say you had a family member, an uncle who owns a restaurant, and he wants a partner to invest in it with him. That's a private business. Okay, and you can do that, but the deal would be between you and your uncle. You'd have to figure out your share of ownership, what rights you have as a business owner, etc. Whereas with common stock investment, you can buy and sell very quickly. And what we mean by that is it's a very liquid investment. If you invest with your uncle's restaurant, that money is going to be tied up for some time because he probably doesn't want to give you back your money, say, in a week, right? Probably wants to keep your money for a period of time so he can make some investments in business. With common stocks, doesn't matter. If you buy a common stock, you can sell it within a minute if you want, really. And that means it's very liquid, right? We can buy and sell. We're not tied to any certain stock, right? If a company starts doing poorly, we might want to sell that stock, right? Because we don't want to watch, the company keep getting worse and worse, the value of our investment declining. So we might sell it immediately. So that's one big advantage, liquidity. The second one is just financial information in general. Okay, when you invest in a private business like your uncle's restaurant, he's not under any necessary obligation to give you financial information, right? Financial statements or showing you the bank account, things like that. Yes, no reason to do that unless you've agreed to certain terms. But with public companies, they're required to share information with their investors, okay? And even the public at large. So if you need financial information for a big company like Costco, for example, you can go on their website, go into an investor relations area, and you'll find all their financial information, generally for a number of years as well. So that's a big advantage. We can see what's going on in a public company. We can read their financial statements. We can read their management discussion, right? They talk about how they did the past quarter or the past year, and we can see what's going on inside the business. Doesn't mean we have complete transparency, right? There's a lot of stuff that goes on in big companies that we're not going to necessarily be privy to, but at least we get their financial information and we can see how they're doing over time, which is important for an investment. So let's shift gears a little bit and talk about bond investments. Okay, so stocks and bonds are kind of the main investments that we make. Bond investments are basically lending. Okay, you have to think of yourself as a bank almost, who's lending money out to different companies. That's what you're doing when you're buying a bond. These are also called fixed income, corporate debt, things like that. They all mean the same thing. We're giving some money to a company, and they've agreed to pay us that money back at a point in time, as well as to provide interest payments to us. Okay, they're borrowing money from us. And so what matters here is a little bit different than what we would look at if we were making a stock investment. Okay, because we want to make sure that the credit rating of that company is good. Just think of if you walk into a bank and ask for a mortgage, they're going to say, okay, well, you have to show us, your income, your other financial obligations you have. They're going to want to know something about your financial background. Same thing with bond investments. You want to make sure that the company you're lending money to is doing well enough to pay you those interest payments and to pay you your investment when it matures. Okay, so bonds always have a maturity. So maybe you're lending money for 1 year, 2 years, 7 years, even 30 years. Okay, you're giving that company that money for that period of time. At the end, they're going to return it to you. Okay, when that bond matures. And so that's what we're talking about when we say the principal amount of the bond is the initial amount you've given them. So say it's $1,000, they're going to give you 1,000 when that bond matures, and whatever the interest is along the way. Generally, they're going to pay interest every 6 months up to maturity. Bonds are generally less risky than stocks, not always the case, but for the most part, you can kind of assume that a bond investment is safer than stock investments. Okay, bonds don't move around in value as much. Remember, we talked about volatility and how much those prices move. Bonds stay in a fairly stable kind of range over time, whereas stocks are obviously moving around quite a bit. So you have a better chance to get that investment back at maturity as opposed to stock investment. And bonds, we talked about the interest payments, right? That's your stream of income that you're collecting. So someone, say, who's retired and has some investments might want more bond investments because they're providing a regular stream of income. Stocks, if we go back to that concept of dividends and paying out some of the share of profits, those dividends are not mandatory, okay? The board of directors will declare that they want to pay a dividend, but they don't have to, okay? It's at their discretion. Whereas with bond investments, it's written into the contract that they have to pay that interest payment, right? And if they don't, it's an event called default. They're defaulting on the payment. So if you're a retiree and you want income, right, because you're retired, bond investments tend to make more sense. Whereas if you tend to be younger, maybe in your 20s, 30s, and you're working, you might invest in common stock because you want that to grow more. And common stock is riskier, but it also provides a higher return over time, right? So you have more time, you can invest longer, you might buy stocks. So let's just summarize some of the different characteristics of a few investments we talked about. So you can see there's a few things on the side. On the left-hand side, liquidity, risk, return, income. And we've got our 3 different types of investments at the top. So stocks, very liquid, right? We can sell them very easily. It's not always the case. Sometimes there are stocks that can be difficult to buy and sell. But for the most part, they're very liquid. Bonds are sort of medium liquidity. It's not as easy to buy and sell as stocks, but for the most part, it's very simple. And cash, obviously very liquid. We can access our cash whenever we need it because it's sitting in an account. We just need to take it out. Risk, obviously, stocks are going to be the highest risk on this display of different investments. They move around in price a lot, and we can see that if we look at the stock market day to day, right? It moves up 1% one day, maybe down 2%, etc. Whereas bonds aren't really going to move around in price that much, but they can. And bonds are really tied to interest rates in general. So when you hear on the news, they're talking about interest rates going up, that tends to have a negative effect on bonds. Okay, the bond prices will go down when interest rates are going up, and vice versa. And we're not getting into bond pricing and how it works, but just understand interest rates rising is a bad thing for bond prices. Okay. Cash obviously is low risk. We can access it. We're not going to lose it. It doesn't decline in value per se, right? I say that because what affects cash? Well, inflation, right? When you have high inflation, the value of cash is going down. Okay, so we can lose on cash, but we're not losing it in the sense that $100 became $40, right? But inflation will eat away at your purchasing power over time. So it does have some risk to it. And then if we talk about return, obviously that's related to risk, remember, and you can see just looking at the chart, the risk and return are related for each of these. High risk, high return, medium risk, medium return, and low risk, low return. So it's a very tight relationship between those two concepts. And this is demonstrating it in the table here. And then income. Stocks might be low, right? You might have a company that's really reinvesting all their profits into business, and so their dividend payments aren't going to be very high, or they might be nothing at all. On the opposite spectrum, you might have very stable businesses, like a utility, for example, providing electricity. They have a stable base of customers, so they can generate enough cash flow to pay a high dividend to their investors. With bonds, again, you get a range of income, and it's going to depend on a number of different variables. But usually it's something to do with the current state of interest rates, the credit rating of the company, things like that, right? So there's a number of different things they look at to set that interest rate on that bond. So it can be low to high. And then cash, we know the income is quite low. It is based on short-term interest rates, and they tend to be quite low in general. Although, as we've seen lately, they've increased a little bit. So that's just a quick summary. And just to show you an example of what it looks like if you were actually to buy a stock, this would be in the case if you were entering your own order, right? There's self-directed investments you can make where you do all the buying and selling yourself. You could also hire someone, financial advisor, or a portfolio manager to look after your money, and they'll be doing the same thing. So this is just to show you what it looks like, and quite simply how easy it is to buy stocks. You can see where we've got an order here. We've got a symbol, QSR, CA. QSR stands for Restaurant Brands International. Okay, that's the company that owns Tim Hortons and Burger King. So large fast food company. The CA refers to a Canadian market. So this stock happens to trade on the Toronto Stock Exchange. And then we're just saying what we want to do. We want to buy it, sell it. How many shares do we want to own? We want to own 100 in this case, so we're going to buy 100 shares. The price tag. So there's basically a couple of different basic types of orders you can enter. A market order is simply you want the best price available. Okay, you want to buy 100 shares of QSR no matter what the price. You want immediate execution. The alternative would be to put a limit price. A limit price just means we don't want to pay more than, say, $45. Okay, that's the limit we're willing to pay. The risk of putting a limit price would be if the stock goes past that, we might not get our stock filled. We might not get the order filled if the price goes up too fast. So market orders are for immediate execution. You want to make sure you own it, but you're not going to know what you pay. A limit order, you know what you're willing to pay at the risk of not actually getting that stock. Okay, so a couple of different types of prices we can use. And there's different expiries. Typically, these are just bought the same day, but you could have this order open for, say, a month. And if the price came down to what you want to buy it at, the order would get filled. Stuff on this side, just to kind of briefly go over some of it. You can see the price this is trading at, $75.21 was the last trade. It's going to show you how much it changed in price since the prior date that it was trading. There's a bid and an ask. What's a bid and an ask? Well, there's buyers and sellers. Okay, and if you think about just a big room full of people, say half of them are buying and half are selling. Okay, the people that are buying are bidding on that stock. So they're willing to bid a certain price for QSR. Maybe it's $70, maybe it's $74. Everyone's going to have their own price in mind about what they're willing to pay for that. And those are all the bids. On the selling side, the sellers of QSR are asking a price. Okay, they're asking, say, $76 or $77. Usually it's above what the price is at, right? And all those sellers have different prices in mind. When a trade happens, that means that a buyer and a seller agreed on the price, okay? And we could see someone agreed on the price at 75.21. A buyer and a seller got together and transacted. We don't know how many shares necessarily. Sometimes it does show you the previous trade, but generally speaking, we won't know that. It doesn't really matter. It could be 100 shares, it could be 5,000 shares, right? We don't know, but someone traded at that price, and that was the last price we saw. Lots, you don't have to worry about lots. I won't really get into that, but we can see what the stock price opened at that day, 75.03, the high for the day, the low for the day. Those are sort of relevant more for active traders, right? People are buying and selling throughout the day. But if you're talking about an investment, we generally talk about, you buy the stock and then you hold it for a period of time, right? You're not immediately flipping it, sort of doing short-term trading. Volume, we could see how many shares of QSR traded that day, 265,000, so quite a bit, but you'll see some bigger companies in the US like Apple, Amazon, they trade tens of millions of shares every day. So that would be just an example of buying a stock. Buying bonds, we talked a bit about bonds, but buying bonds is a little bit different than buying stocks. Okay, you can't necessarily go and order it the same way you can stock. It's slightly different, right? We're dealing with investment dealers now. So investment dealers are big banks, RBC Dominion Securities, CIBC Wood Gundy, Bank of Montreal, Nesbitt Burns. Those are all investment dealers. And this is what they do. They buy and sell stocks and bonds all day long. If you want to buy a bond, you have to go to one of these investment dealers, not physically, you just phone them. And you would ask them, you would say, okay, I have a bond in mind. I want to buy QSR or Restaurant Brands International, and I want a bond that matures in 5 years. Okay, so they're going to go and look in their inventory. They keep an inventory of bonds, just like a store is going to have an inventory of milk or bread, right? They have different bonds in inventory. And the problem with the bond market is some of those investment dealers might not have that bond you want. Okay, so if I approach CIBC and I ask them for a certain Restaurant Brands International bond, they might not have it. And I have to go across the street, talk to RBC or Bank of Montreal, whoever it is. So it's a little bit different, but not that difficult. You can generally find what you're looking for. Just a quick note here, obviously the longer the term, that loan or the bond, the higher the interest rate. And this is just in general, sometimes it can be kind of flipped around, but for the most part, the longer the term of that bond, the higher your interest rate. And the reason behind that is the longer you're lending a company money, the longer basically there is that they can get into trouble, right? If their profits decline over time, you might not get your bond back when it matures, right? So that's a risk to you as a bond investor. And you compensate that by charging a higher interest rate to that company. So that's really what that means. And mutual funds and ETFs. So we talked about stocks and bonds. Mutual funds and ETFs are basically just different vehicles you can use to buy stocks and bonds, okay? So we looked at a case where we bought an individual stock, 100 shares of QSR, In this case, maybe we're going to buy a Canadian equity mutual fund. Okay, a Canadian equity mutual fund is just basically a pool of investors have got together. They put all their money together and they've said, okay, we're going to hire a mutual fund manager to look after this pot of money for us. And that mutual fund manager is in turn going to go out and buy stocks and bonds, right? Or maybe commodities. There's all sorts of things you can put in a mutual fund. It's really just a way for investors to access a large number of stocks, okay? So if you only have, say, $500 to invest, you might not be able to buy 100 shares of a stock, right? So you would invest in a mutual fund wherein they can take your $500, pool it with everyone else's money, and they're going to go buy, it could be 100 different stocks, could be 500 different stocks, okay? So they have access to more stocks, they can diversify more, do all these things. Whereas if you only have $500, you're not really able to access everything you can. Okay, so that's one reason why you would buy a mutual fund. Mutual funds and ETFs also vary in risk, right? Just like stocks, we have high risk and low risk stocks. Mutual funds are also on the same spectrum. Okay, we might have very safe mutual funds that only invest in short-term government debt, right? Very safe security. We might have a mutual fund that invests in IPOs or initial public offerings, right? These tend to be riskier securities because they're newer, they're unproven. You know, think of a company like Peloton with the bikes. They went public a couple of years ago, I think. That's a newer investment for investors, so it's riskier, right? So mutual funds can invest in things like that as well. ETFs are very similar to mutual funds. Okay, they do the same thing about pooling investors' money together, in turn buying some other stocks and bonds. The only difference is the ETFs tend to be traded just like stocks. Okay, so instead of the case where we bought 100 shares of restaurant brands, we're going to buy, say, $5,000 of a certain mutual or certain ETF, and we're going to invest 40 shares into that ETF. Same principle, same concept, except in this case, instead of an individual stock, you have a fund that's invested, right? And so that fund is going to have a whole bunch of stocks within it. So that's mutual funds and ETFs. And then account types. So where do you buy investments, right? People want to know, like, how do I buy investments? Well, you have to open an account with either a bank, an investment dealer, a financial advisor, right? You have to find someone who can open one of these investment accounts for you. And really think of an investment account as basically just, it's like a checking and a savings account, right? You have different accounts for different purposes. One to write checks for, and one is to save money in. Investment accounts are the same, they just have different rules for each different type of account. Okay, and I've listed a few of the more common ones you'll find, generally for individuals who are investing. These are kind of the starting point. Registered retirement savings plan. So if your bank is offering you RSPs of any sort, that's what they're talking about. It's really just a tax sheltered account. Okay, so whatever you put into that account, if you grow it, say a capital gain, and you increase the price of your stock, the government cannot tax that. Okay, and they're not going to. However, once you take money out of that account, right? You've made some money on your investments, you've cashed them in, and you say, I want $2,000 out of my investment account. When you take it out of that RSP, the government is going to want a portion of it. Okay, so it's taxed when you take money out. Tax-free savings account is a similar concept. Okay, so the investments inside that are not taxed. So if you make capital gains, again, or dividend income, interest income, the government will not tax that. However, the money you've put into that account has already been taxed. Okay. A way to think of this is you earn income throughout the year and the government is taxing you. And so all the income you have at the end of the year is after tax income. That's what you're putting into a tax-free savings account. Okay. They're not going to tax you when you take it out, though. It's only taxed once you've earned it. Then you put it into that TFSA. Everything is tax-free inside. Okay. A cash or non-registered account, this is just a straightforward investment account. Okay, you can do a lot of things with these types of accounts because there's usually no tax rules associated with them, right? Anything you earn in there is going to be taxed. So interest income, dividends, any capital gains you make on your stocks, those will be fully taxable in a cash or a non-registered account. And then a registered education savings plan. This is for people with children. They tend to be under the age of 18. And typically, the government is providing a savings grant when you put money into it. There's certain limits and lots of details about how they work, which I won't go into. But just know that when you contribute to an RESP, the government is actually adding additional money into that for that education. Okay. And there's rules about how you take them out and you pay for your child's education as well. You can read about that on the Government of Canada website. But those are basically designed for a very specific purpose, right? In this case, education for your children. So again, those are just different account types, right? This is what you need to open if you will actually want to invest in stocks and bonds or mutual funds, things like that. And I've just listed a few ideas here for resources for further information, okay? Investopedia is a very good site for just general information on investments. They have a lot of definitions. They have some things where you can go into if you're just a beginning investor and you want to learn about investments. It's a very good place to kind of read up on things and how they work. The rest of these are basically business news, right? BNN Bloomberg is Canadian, Globe Mail, Canadian newspaper, and CNBC. These are good places if you actually want to invest in a stock. You can go to these sites, kind of punch in a company name, and usually you'll get some news articles from past whatever year or so. And you can kind of see what the company is doing. Another great resource would be to actually go onto the website of the company you're looking at, right? So if you're looking at Stanley Black & Decker, for example, as an investment, you might go onto Stanley Black & Decker's website in the investor relations area and look for some financial information, read about what the company does, things like that. That's really if you really want to get into it and kind of learn more about your companies. So I think we've come to the end. So thank you for your time, and I'm always happy to answer any questions as a follow-up. If you want to email, send in questions, I can get them afterwards, but thank you for your time.